Every day, billions of dollars cross international borders as countries buy, sell, and trade with one another. But with all that constant movement, how does a nation measure if it is accumulating or losing wealth? Economists track this through the balance of payments. It is the financial record of every transaction between a country's residents and the rest of the world, usually measured over a single year. The largest part of this record is the current account. This is where we monitor the day-to-day income a nation receives and the expenditure it makes in its dealings with other countries. This ledger categorizes every movement based on where the cash is headed. Any transaction that brings money into the country is recorded as a credit, while any transaction that sends money out is a debit. Tallying these credits and debits allows us to determine the actual direction of a nation's wealth, whether it is earning a surplus or running a deficit on the global stage. The current account is built in 4 layers, starting with the trade in goods. Also known as the visible balance, this tracks physical, manufactured items, things like food, raw materials, and machinery. When Japan sells Toyota cars to foreign customers, those goods leave the country, but the money flows into the Japanese economy. This creates an inward flow of money, or a credit, on the visible balance. In these calculations, we ignore the physical direction of the cargo and look only at the movement of the money. If a domestic resident buys a German car, money flows out to Germany, creating an import debit. The second layer is the trade in services, or the invisible balance. This covers intangible products like banking, insurance, and tourism. If a foreign tourist flies to London on British Airways, they are purchasing a service from a UK company. Even though no physical product is shipped, money flows into the UK economy, making it an invisible export. Combining the visible trade in goods with the invisible trade in services gives us the total balance of trade. This is the foundational core of the current account. Trade isn't the only way capital moves across borders. The third layer is primary income, which tracks money earned from overseas investments or labor. This includes dividends earned from financial investments in overseas companies, or interest received from loans held in foreign banks. When this money is sent home, it is recorded as a credit. Conversely, when foreign entities operating within the home country send profits back to their headquarters, that money represents a debit. The fourth layer is secondary income. These are current transfers, money sent between residents and non-residents where nothing is provided in return. This includes government aid and charitable donations, and workers' remittances, money sent by people working abroad back to their relatives at home. In countries like Senegal, these remittances can reach 9% of the nation's total GDP. These invisible streams can be enough to pull a country out of a trade deficit and into a net positive position. To find the final balance, we add the results of all 4 layers: trade in goods, trade in services, primary income, and secondary income. When total credits exceed total debits, the country has a current account surplus. A current account deficit occurs when a country spends more than it earns, meaning its imports and outward transfers exceed its exports and inward income. Before calculating any balances, every international transaction must be correctly sorted into one of these 4 categories. Let's run the numbers. We start by calculating the balance of trade in goods. We take the value of exported goods and subtract the value of imported goods. Let's say we have 900 million in exports and 1,200 million in imports. Because the spending on imports exceeds the revenue from exports by 300 million, the result is negative. We call this a 300 million deficit. Next, we factor in trade in services. If our services generated a 60 million surplus, we add that positive number to our goods deficit to find the total trade balance. When we combine a positive 60 million surplus with a larger negative 300 million deficit, we are still left with a net negative result. The total trade balance sits at a deficit of 240 million. Looking at this standard accounting table, we can see the full equation. Below the trade balance, the rows for primary income, listed here simply as income, and secondary income, listed as current transfers, are added to the running total to calculate the final balance on the current account. Using this test your understanding format as inspiration, try applying this logic. Imagine Planet Zog has 2,000 million in exports, 2,500 million in imports, a positive 100 million in primary income, and a positive 50 million in secondary income. What is their final balance? Success depends on consistent tracking of positive and negative signs. A result below zero signifies a deficit, while a positive total marks a surplus. Step 1. 2,000 million exports minus 2,500 million imports gives a 500 million trade deficit. Step 2. Add the 100 million primary and 50 million secondary income. This leaves negative 350 million. Planet Zog has an overall current account deficit of $350 million. Reviewing the items in this self-evaluation checklist highlights an important distinction you will see on exams. Always check if a question is asking you to calculate just the balance of trade and goods or the overall current account balance, which requires all four components. Keep the basic accounting rules straight. Credits bring money into the country and are positive. Debits take money out of the country and are negative. Running a deficit means a country is spending more money internationally than it earns. Running a surplus means it earns more than it spends. Ultimately, the current account identifies whether a country is a net contributor to the global economy or a net borrower, revealing exactly where a nation stands in the global ledger.